Widely regarded as one of the most successful investors of all time, Warren Buffett has built his fortune through a unique and often enigmatic investment strategy. While his approach is closely followed by millions of investors, one aspect of Buffett's strategy that has puzzled many is his stance on dividends. Unlike some investors who prioritize high dividend-paying stocks, Buffett's Berkshire Hathaway has historically avoided paying significant dividends. This video aims to delve into the depths of Buffett's dividend dilemma, deciphering the reasons behind his unconventional approach and exploring the hidden strategies that have contributed to his unparalleled success. The traditional view on dividends. Before diving into Buffett's dividend strategy, it's crucial to understand the traditional view on dividends. For many investors, dividends are seen as a reliable source of income. Companies that regularly pay dividends are often perceived as stable and financially sound. Dividend payments can provide investors with a steady stream of cash, making them an attractive option for those seeking income in addition to capital appreciation. Buffett's dividend philosophy. Warren Buffett's perspective on dividends is unconventional, particularly when compared to the traditional view. Berkshire Hathaway, Buffett's conglomerate, has historically refrained from paying substantial dividends to its shareholders. Instead, Buffett prefers to reinvest the company's earnings back into its operations or allocate capital to new investments. One of the primary reasons behind Buffett's aversion to dividends is rooted in his belief that he can deploy capital more efficiently than shareholders could on their own. By retaining earnings within the company, Buffett gains the flexibility to seize lucrative investment opportunities as they arise. This approach aligns with his long-term focus on value creation and compounding returns. Buffett's preference for share buybacks. While dividends might not be a prominent feature of Buffett's strategy, share buybacks play a crucial role in capital allocation for Berkshire Hathaway. When Buffett believes that the company's stock is undervalued, he opts for share repurchases. This strategy has several advantages over paying dividends. Firstly, share buybacks are a tax-efficient way to return value to shareholders. When a company repurchases its own shares, shareholders who decide to sell their shares incur capital gains taxes, which are typically lower than the income taxes levied on dividends. This tax advantage is particularly beneficial for long-term investors. Secondly, share buybacks enhance the ownership stake of existing shareholders. When a company repurchases its shares, each remaining share represents a larger ownership interest in the company. This can lead to increased earnings per share, EPS, a metric closely watched by investors. Buffett's critique of dividends. In Buffett's annual letters to shareholders, he has expressed his views on dividends, often with his characteristic wit and wisdom. He argues that dividends are not inherently value-enhancing for shareholders. Instead, he contends that investors should focus on the overall return on invested capital, which includes both capital appreciation and retained earnings. Buffett's critique of dividends extends to his belief that they can signal a lack of investment opportunities within a company. When a company pays out a significant portion of its earnings as dividends, it may indicate that the management lacks confidence in the firm's ability to generate attractive returns through reinvestment. In contrast, Buffett prefers companies that can deploy capital effectively to fuel growth and create long-term shareholder value. The power of compounding. One of the fundamental principles of Buffett's investment philosophy is the power of compounding. By reinvesting earnings back into businesses that can generate high returns on invested capital, the compounding effect accelerates wealth creation over time. Buffett's focus on businesses with durable competitive advantages, often referred to as economic moats, is central to this compounding strategy. Dividends, according to Buffett, interrupt the compounding process by distributing cash to shareholders. He believes that investors can achieve superior returns by allowing companies to reinvest earnings and compound value over the long term. In this way, the Berkshire Hathaway portfolio becomes a collection of businesses with compounding engines driving wealth creation for shareholders. Buffett's historical examples. To illustrate his point about the effectiveness of retaining earnings, Buffett often cites historical examples of successful companies that reinvested in their businesses rather than paying dividends. Coca-Cola, a longtime holding in the Berkshire Hathaway portfolio, serves as an exemplary case. Instead of distributing profits as dividends, Coca-Cola has consistently reinvested in marketing, distribution, and product innovation, solidifying its market dominance and generating substantial returns for shareholders over the years. Similarly, Buffett highlights the success of See's Candies, a confectionery company owned by Berkshire Hathaway. Despite being a relatively small acquisition, See's Candies has demonstrated the power of compounding through strategic reinvestment. The retained earnings have been used to expand the brand, introduce new products, and strengthen its market position. Buffett's endorsement of quality businesses. Another aspect of Buffett's dividend dilemma can be traced to his endorsement of quality businesses. Buffett places a premium on companies with strong competitive advantages, reliable earnings, and the ability to endure economic downturns. Such businesses often have the capacity to generate consistent and growing cash flows. Instead of distributing these cash flows as dividends, Buffett prefers companies to reinvest in their operations, make strategic acquisitions, or repurchase shares when the stock is undervalued. This approach aligns with his emphasis on long-term value creation and the compounding effect, reinforcing the notion that dividends may not be the most efficient way for quality companies to allocate capital. The Berkshire Hathaway portfolio. A closer look at Berkshire Hathaway's portfolio provides further insights into Buffett's dividend strategy. The conglomerate's holdings include a mix of businesses ranging from insurance and energy to consumer goods and technology. While some of these companies pay dividends, Berkshire Hathaway as a whole has not embraced a high dividend policy. Instead, the portfolio is characterized by a combination of businesses with robust growth potential, those with sustainable competitive advantages, and others that generate significant cash flows. The diversity of the portfolio allows Buffett to allocate capital dynamically, adjusting the mix of businesses based on market conditions and investment opportunities. Buffett's economic moats, central to understanding. Buffett's dividend dilemma is the concept of economic moats. An economic moat refers to a business's ability to maintain a competitive advantage over its rivals, thereby protecting its market share and profitability. Buffett seeks businesses with wide and enduring moats, as they are more likely to withstand competition and generate superior returns over the long term. Companies with economic moats, according to Buffett, have the capacity to reinvest earnings at high rates of return. This ability is a key driver of compounding growth and value creation. Dividends, in Buffett's view, can undermine the economic moat by redirecting cash away from strategic investments that would enhance the company's competitive position. The role of patience in Buffett's strategy. Another critical element of Buffett's dividend strategy is the virtue of patience. While some investors may prioritize immediate income through dividends, Buffett encourages a long-term perspective. He believes that investors who are patient and allow companies to reinvest earnings will be rewarded with higher overall returns over time. Buffett's own track record attests to the power of patience. Many of his most successful investments, such as Coca-Cola and American Express, have been held for decades, allowing the compounding effect to work its magic. By avoiding the temptation of short-term gains through dividends, Buffett positions himself and his shareholders for sustained, long-term success. The role of inflation and taxes. Buffett's aversion to dividends is also influenced by considerations of inflation and taxes. In an environment of rising prices, dividends may lose their real value over time. By contrast, companies that can reinvest earnings in projects with returns exceeding the inflation rate have a better chance of preserving and growing shareholder wealth. Moreover, Buffett is mindful of the tax implications of dividends. In the United States, dividends are typically taxed at a higher rate than capital gains. By favoring share buybacks over dividends, Buffett not only enhances shareholder value through increased ownership stakes, but also provides a tax-efficient means of returning capital to investors. Challenges to Buffett's dividend strategy. While Buffett's dividend strategy has been highly successful for him in Berkshire Hathaway, it is not without its challenges and criticisms. Some argue that paying dividends can be an effective signal of a company's financial health and management's confidence in its future prospects. Additionally, dividends can be an attractive feature for income-focused investors, especially in periods of economic uncertainty. Moreover, the rise of dividend-focused investment strategies and the popularity of dividend-paying stocks in the broader market have led some to question whether Buffett's approach is becoming less relevant in today's investment landscape. As more investors seek income in the form of dividends, companies that prioritize dividend payments may garner favor, potentially impacting the relative performance of Berkshire Hathaway and similar non-dividend paying entities. Warren Buffett's dividend dilemma is a central and intriguing aspect of his investment philosophy. His preference for retaining earnings, reinvesting in businesses with economic moats, and favoring share buybacks over dividends reflects a commitment to long-term value creation and the power of compounding. While his approach may deviate from conventional wisdom, Buffett's success speaks volumes about the effectiveness of his strategy. Investors looking to decode Buffett's hidden strategy should consider the interplay of factors such as economic moats, compounding, share buybacks, and the role of patience. By understanding the rationale behind Buffett's dividend dilemma, investors can gain valuable insights into how to identify and capitalize on quality businesses capable of delivering sustained, long-term returns. As the investment landscape continues to evolve, Warren Buffett's timeless principles serve as a beacon for those seeking to navigate the markets with a focus on enduring success. The dividend dilemma, far from being a paradox, is a deliberate and calculated aspect of Buffett's broader strategy, underscoring the importance of disciplined capital allocation and a steadfast commitment to creating shareholder value over time.